episode 19, the final technical episode of the series, and I want to spend it on something practitioners underestimate until something breaks. Risk management in NDF portfolios is not the same as risk management in standard forward portfolios. The instrument looks similar, the risk profile is different, and the failure modes are specific. Let me start with market risk, because that's the foundation. The primary metric is delta exposure. Delta tells you how much your portfolio value changes per 1 pip movement in the exchange rate. For a long dollar yuan NDF position, 1 pip of renminbi depreciation generates profit. 1 pip of appreciation generates loss. Delta converts position size into that sensitivity. $10 million notional in dollar yuan gives you a delta of roughly $1,000 per pip. Across a multi-currency NDF portfolio, you aggregate deltas by currency pair. Long positions in one currency, short in another. Convert everything to a common base, typically dollars. Your net portfolio delta tells you the directional exposure you're running. Value at risk builds on that. For a $50 million long USD Indian rupee NDF position, with the rupee running at around 0.8% daily volatility, your 10-day 99% VaR is approximately $3 million. That means in 99 out of 100 10-day periods, you'd expect losses no worse than $3 million. Emerging market volatility runs considerably higher than developed currency pairs. Euro-dollar daily volatility is typically around 0.4%, the rupee runs at double that. The Turkish lira at 3 to 4 times that. Same notional, significantly larger VaR figure. Your capital allocation models need to reflect that difference. But VaR captures normal conditions. Stress testing captures the scenarios that matter most. Currency peg breaks. CNY devalued meaningfully in August 2015. The Turkish lira lost 30% in 2018, and another similar quantum in 2021. Argentina has staged multiple step devaluations over the years. These events are not in the historical volatility distribution you use to calculate daily VaR. They sit far in the tail. Your stress test library should include scenarios like a 15% overnight CNY move, a 30% lira shock, and a 50% Argentine peso step devaluation. Run those against your current positions. If the results are uncomfortable, reduce or hedge before the event, not during. There is a subtlety in crisis stress scenarios that matters for NDFs specifically. A large depreciation in your favor is not automatically a clean win. When a currency depreciates 20% overnight, the first question is whether your dealer can honor settlement. The second is whether the fixing rate will reflect the true market move or whether capital controls and government intervention will suppress it. The third is whether new restrictions will be imposed between trade date and settlement, preventing the dollar transfer entirely. Stress testing for NDFs has to include operational and legal scenarios, not just price scenarios. Fixing risk is the dimension most specific to NDFs, and the one that practitioners are most casual about until it causes a problem. The fixing rate determines settlement. If the fixing rate diverges from the true market rate on fixing day, your hedge may not perform as expected. The economic exposure moves one way, the fixing moves another. You end up with residual, unhedged exposure and no obvious recourse. Manipulation is a real risk in some NDF markets. A participant holding a large position benefits from nudging the fixing in their favor. Concentrated trading in the fixing window, coordinated positioning across dealers, exploitation of thin liquidity during the publication period. This has been documented in developed currency markets. NDF fixings in less regulated jurisdictions face the same risks. Your monitoring process should compare every fixing rate against prevailing market conditions at the time of publication. A fixing more than 2 standard deviations from pre-fixing market expectations should trigger a review. Not necessarily a dispute, but a review. Document it, understand why the deviation occurred, establish whether it represents a legitimate market move or an anomaly, and get your ISDA confirmation right. Specify the primary fixing source, the exact publication time, the fallback if the primary is unavailable, and the calculation agent who determines the rate if both sources fail. Vague confirmation language creates optionality for disputes at settlement. That optionality will not benefit you. Counterparty credit risk behaves differently in NDFs than in deliverable instruments. In a deliverable forward, if your counterparty defaults close to maturity, you lose the full notional. They owe you currency, they can't pay, you're short the full amount. In an NDF, the exposure is the mark-to-market value. The positive mark-to-market represents what you would receive at settlement if the contract were closed today. That's your replacement cost if the counterparty defaults. It's typically a fraction of notional, but it can become substantial for large, in-the-money positions in volatile currencies. Credit support annexes mitigate this. When your positive mark-to-market exceeds a negotiated threshold, your counterparty posts collateral. Daily variation margin keeps exposures capped regardless of market moves. For major bank counterparties, thresholds are typically negotiated at 0 for financial institutions and up to 10 million for corporates depending on credit quality. The minimum transfer amount prevents nuisance calls for small movements. Get these parameters right at onboarding. Dealer diversification is the other credit control. If 60% of your NDF volume flows through one dealer and that dealer has a credit event, you have a concentration problem. Minimum 3 to 4 active dealers across your NDF program. Establish maximum exposure limits per counterparty and monitor them daily against mark-to-market. Operational risk is where mature NDF programs are separated from immature ones. Trade capture accuracy. The settlement formula is straightforward, but notional, contracted rate, fixing date, and settlement date all need to be correct. A transposition error in a contracted rate generates a settlement dispute 2 months after execution. By that point, neither side has clear, contemporaneous records of the verbal agreement. Dual entry verification, automated reasonableness checks, and same-day confirmation matching prevent this. Electronic confirmation matching should achieve 95% or better on same-day basis. Any unmatched confirmation by end of day gets investigated immediately. Not tomorrow, not end of week. That day. Discrepancies identified early are fixable. Discrepancies identified at settlement are expensive. Settlement reconciliation is separate. When you receive or pay a settlement amount, compare it against your calculated expected amount before releasing payment. A $5,000 discrepancy on a $10 million settlement is a rounding issue. A $50,000 discrepancy is a calculation error or a fixing dispute. Know which before you pay. Risk governance wraps all of this together. Position limits at the currency level, the portfolio level, the tenor level, and the counterparty level. Not as a formality, as operational constraints that trigger automatic escalation when breached. Daily risk reporting showing delta exposure by currency, VaR, mark-to-market, counterparty exposure, and upcoming fixing dates for the next 5 business days. That last element matters. A large settlement fixing in 3 days is not a market risk. It's a cash flow event. Your treasurer needs to know. Contingency plans for 3 specific scenarios: fixing source failure, dealer default, and regulatory restriction on market access. These are not theoretical. Fixing sources have had technical failures. Dealers have had credit events. Governments have imposed capital controls mid-crisis affecting outstanding contracts. Know in advance what you would do. Which fallback fixing source? Which replacement dealer? What your regulatory exposure is if settlement is blocked. Having those answers written down before the event is the difference between managed disruption and crisis. The March 2020 episode is worth remembering. Emerging market currencies move violently. Some fixing sources experienced technical disruptions. Dealer liquidity dried up for 72 hours in several EM pairs. Portfolios without stress-tested frameworks and clear contingency protocols were left managing in real time under pressure with no playbook. The lesson is not that NDF risk management is impossible. It's that the risks are specific, they're known, and the mitigation frameworks exist. You just have to build them before you need them. Next episode is the final episode of Season 1. We step back from instruments and mechanics and look at where FX markets are heading: technology, regulation, geopolitics. What the trading floor looks like in the decade ahead. This is The Trading Floor. I'm David Axtell. FX Cash Products by Luigi Rondinini and myself is available now through all major bookstores and rondinini.com. Chapter 18 covers NDF risk management in full, Delta and VaR frameworks, stress testing, fixing risk monitoring, credit support structures, operational controls, and governance frameworks. For NDF risk tools including Delta aggregators, VaR calculators, stress testing frameworks, and fixing rate monitors, visit learn.rondinini.com. For Treasury teams building NDF risk governance frameworks, Luigi advises through rondinini.net. And for institutions managing emerging market FX portfolios, I'm available through axtellconsulting.net. See you in episode 20, the last episode of The Trading Floor.